Well, hello, Matt. We're going to have a good episode today. You and I have been talking quite a bit about the banking sector, specifically Silicon Valley Bank, and
Yeah.
what's going on in today news. Potentially, Credit Suisse having issues. Signature Bank over the weekend. So, what we're going to do is today's episode, titled "Lessons from the Silicon Valley Bank Collapse," is going to be a focus of what we can learn from what happened with Silicon Valley Bank, unpack it, see if there's more to this story than what's being reported, and then what we can learn from it.
Mhm.
So today's episode 53, and Matt Marmerstein and I, we're going to dive into this. So let me start out with some experiences that people may not be aware of, and that is that we lived in Silicon Valley in Cupertino in the late 90s all the way through a good part of 2000, having offices downtown, and it was incredible, Matt.
Yeah.
Um, uh, People were just making money hand over fist. It was amazing. The traffic grew as people moved. Programmers and engineers were making phenomenal amount of money. But the real key is when they would go public, and it was all over the place. People going public, and I remember friends of ours that were receptionists and secretaries getting $1 million from an IPO as
Wow.
receptionists. And
Right.
needless to say, executives were getting tens of millions of dollars. And one of my wealthiest clients became a billionaire,
Wow.
4 doors down from us, and his son was a good friend of my son. We met at the soccer field. Here I'm talking to a guy that's a billionaire, right? So it was
Amazing.
it was it was incredible. In fact, I joke about with Niall because he was 10 years at the time, 10 years old at the time, but he'd say, "Dad, why isn't your company going public? Why can't we have cool toys and go on lavish trips?" And of course, he didn't understand. I was already working for a New York Stock Exchange firm, an investment company. We had already gone public, So
Darn.
yeah, yeah. So, but needless to say, living in Silicon Valley and experiencing this was amazing. And everybody knew about Silicon Valley Bank because they were in the heart of a lot of the funding of a lot of these startup companies that grew phenomenally. They were a big lender. Their stock did amazing during those years and continue to do even well in 2020 and 2021. So it was a big shock to everybody last week to learn that Silicon Valley Bank was going into receivership, and the FDIC and the federal regulators took it over.
Mhm.
Stock plummeted, and now it's untradeable.
Right.
So, what can we learn from this, and what is the takeaway? And I think the question at hand, Matt, is this a systemic issue in the banking industry? Is this another 2008 financial crisis, or are these isolated events, Credit Suisse, Signature Bank tied deeply with cryptocurrency, and Silicon Valley Bank? Are these three separate situations, and or is this going to lead to something even more? And so
Right.
that's the topic at hand. Is it systemic, or is it isolated events that we can learn from, but it's not going to turn into a contagion into other areas?
Mhm.
So let's refer to this as airplane crashes. We all know that I'm a pilot, and an airplane crash, interestingly, does not happen because of one particular event and then they're doomed and they crash and die. It's typically a combination of incidences that lead to the final incidents that everybody knows about, and they crash them. And so I, looking at Silicon Valley Bank, and you and I talking about it, Matt, uh,
Yeah.
this was situations that started developing not in 2020, and we'll get into what happened to them in 2020, which was that final event. But there
Right.
was events that started developing as early as 2015.
Yeah.
And you did some research in
Yeah.
2015, and Greg Becker petitioning to the regulators. So tell us about the research that you came across.
Yeah. So basically, Greg Becker submitted a statement to the Senate panel in 2015.
And by the way, he's CEO of
CEO, right, of
Silicon Valley Bank,
SVB. Yeah,
took
and
over.
he really wanted to exempt his bank or banks and his own from a lot of the regulations that were passed in 2008. And senators warned against it and stuff, but Becker,
Again, Frank Dodd, Frank Barney, and Barney Frank and Chris Dodd, they were strong advocates of what became regulations there not to make these changes.
right, right, yeah, but they got out their checkbooks and they started lobbying, and they were successful.
Yeah.
And one of the big quotes that I found really funny was all back then, when he was arguing with the legislators, he said that Silicon Valley banks, they have deep understanding of the markets that it serves, and they have strong risk management practices.
Right.
And
right.
I think we'll find out that they may have strayed from those in the latter years.
Yeah.
So that was kind of an interesting thing that we found out, that it really started all the way back then.
Yeah. So the beginning of the cracks in their organization goes back to 2015. They were given relaxed regulations. They were able to reduce their reserve requirements from $500 million to 250, to 250, and at the same time, that set up the beginning of events. And the next event that widened those cracks and created the downward spiral was 2020. And what happened in 2020 was a tremendous amount of liquidity as a result of government subsidies. Billions of dollars were issued to just about everybody. And I hope our listeners got some of that money.
Yeah, we always do.
Yeah. So there was those that were unemployed had bonuses, doubled their unemployment benefits. Businesses received what was called the PPP funding to cover payroll, payroll protection. Companies were given short-term loans or interest-free loans. So the money was rampant.
Yeah.
And all this money flowed into the economy, and we wrote about it. Household savings soared almost tenfold in 2020 and 2021. People were floating in money. Part of the reason that we've talked about unemployment stayed so high and companies couldn't hire is because people had money. Why go to work? And why go to work with double employment benefits, right, Matt?
Right.
So all this money, well, what happened with this money? Well, guess what? They paid off some of their higher interest rate loans, which is not good for banks because they have these loans. Loans are an asset to a bank. So that's income coming in. And so loans are an asset. If higher interest rate loans are getting paid off and then reissued with lower interest rate loans, that's reducing banks' income.
Correct.
Deposits are liabilities. So a lot of people don't understand how banks work. It's the opposite. Deposits are liabilities because that's money that's not theirs that they owe back to the depositors and with interest. And loans are assets. That's money that they lend out and people owe them their money back and at an interest rate.
Right.
We have an arbitrage taking place here that was getting set up starting in 2020, where mortgage rates plummeted down to 2 and 3%. And we've talked about mortgage rates. One client of ours has a 1.75% 30-year fixed mortgage.
Yeah, amazing.
Right? So banks, including Silicon Valley Bank, and they had their Silicon Valley Bank mortgage department company, issuing loans in the hundreds of millions. And so all is fine in 2020 and 2021 because deposits were at zero. In fact, the 10-year Treasury was at 0.49% in 2020 and 2021. So they're fine. They're lending out at 2 and 3%, and they're paying out zero. So they're good. But the cracks were starting to widen as people were bringing in deposits. And what was happening here is that they were issuing loans that are fixed but not subject to any risk to interest rates starting to go up.
Right.
So you had mentioned that Greg Becker had recommended the lowering of reserves because they have an astute understanding in the marketplace, right?
Right.
Yeah.
Yeah, but he didn't listen.
He did not. Yeah, they did not. And so we have Wall Street Journal did some reporting over the weekend, and they found out that last year, Greg Becker and his executive team, they actually removed hedges against rising interest rate. And by the end of last year, Wall Street Journal pointed out that they had over $14 billion of hedges that they either let expire or removed. And in fact, Greg Becker and some of their executive team were reported at an investor conference middle of last year to actually say that they are not concerned about rising interest rates, but actually are starting to hedge against what they call down rate sensitivity. In other words, they were removing hedges to protect against rising interest rates and were actually investing on the premise that interest rates would go down middle of last year.
And this is with a year of the Federal Reserve yelling at us.
Yeah.
We're raising rates.
Yes. Yeah.
And they just blindfolded themselves.
Yeah. Yeah. This is like the scenario where a pilot is in the clouds, zero visibility. The only thing the pilot has to reference are the instruments. You can't trust what's out there. And as I've talked about, a pilot flies by their butt. So when the butt tells you you're in a descent, your mind connects the dots and makes adjustment. But in a downward descent with zero gravity, you can actually feel like you're flying level when you're actually in a very downward spiral.
Wow.
And in a situation with zero visibility, you have to only pay attention to your instruments. You have to ignore what your mind and what your butt is telling you.
Wow.
And this is a situation where the bank's in a downward spiral. Their instruments are telling them, and Jerome Powell is making it very clear they're going to raise interest rates, and they actually do the opposite. This is like a pilot thinking that they're flying up and ascending when they're actually descending and pushing the yoke forward and diving the nose down and increasing their descent. And that's exactly what they did. Instead of hedging against what Jerome Powell was making very clear their objective, they actually did the opposite.
Wow.
And that was the beginning of where they were getting close to a death spiral. But there are times, even in horrific situations like this as a pilot, you still have an opportunity to right the plane, change what you're doing wrong, reverse, and get back to a level flight. And they had a chance to do this last year, and they were losing billions of dollars in the markets with their treasuries. And this is what was the final blow.
Yeah.
We wrote about it 2 weeks ago, the melting recession worries, in which the rise of interest rates offsets bonds. So bonds go down when interest rates go up. Well, typically interest rates go up a little bit here and there and bonds fluctuate. Well, last year, the Federal Treasurer and the Federal Reserve raised the discount rate from 0 to 0.25 to 4.5% to 4.75. One of the fastest rise in interest rates, and you'd have to go back to the 1970s when they raised rates from 5.25% to 14%. So a similar run, and with the exact same objectives, which is to slow inflation. So in the midst of the Federal Reserve making it very clear their intentions and their target, which is 2% inflation, they did the opposite. And not only did they not hedge against the rising interest rates, their treasury bond portfolio, and we wrote about 20-year treasuries, they dropped 33% last year.
Wow.
Now with banks, they have to maintain a ratio of assets to liability. And remember, assets are loans and treasury portfolios, and liabilities are their debts. So if their treasuries drop 20 to 30% in value, they have to make up that difference. And these are multi-billion-dollar portfolios. Just their hedge was $14 billion. So that gives you an idea of how big that portfolio is. So that was the final straw to Silicon Valley Bank, was the ignoring the feds, ignoring risk management, and then worst case scenario is the portfolio declining.
Wow. And unfortunately, it looks like the heads of the company kind of knew it was coming.
Yeah.
I think we saw that January 2023 that they kind of had some suspects, and we can look back and see that they filed to sell. I think Mr. Becker sold about 2.3 million. Mr. Beck sold about 575,000.
Right.
About 33% of his holdings. So
yeah,
pretty messed up. But hey, the good thing though is that you have been preaching about this all year. For the last year, and we knew it was going.
Yeah, several years. We referred to the 1970s, this era of rising interest rates, and the impact to the bond markets, the impact to retirees that were trying to be conservative with their investment portfolio. And so we did last year, we removed all of our core bond funds. We increased our cash holdings from 10 to 15% and minimized a lot of our risk. We invested in those very same hedge funds that hedge against rising interest rates last year and minimize the decline. The NASDAQ dropped 33%. S&P 500 dropped 19%. The small and mid caps dropped in their 20% range. And so, the bond market was more volatile last year in some parts of last year than the stock market.
Wow.
And so we had been talking about those risks. So the question at hand that we introduced at the top of the podcast is Silicon Valley Bank an indication of a systemic issue that's going to reverberate and contagion throughout the financial markets, or is it an isolated event? And I think, Matt, it's both. I think Silicon Valley Bank is an isolated event of a number of missteps that go back to 2015, as you pointed out, and then leading to the pandemic, which who would have thought billions of dollars would be issued by the government and literally handed out to everybody,
right?
And then create a scenario where you have hyperinflation of too much money chasing too few goods. And then in 2022, March, the Fed saying enough of the inflation, we need to address it. We need to aggressively implement the same rate hike policies of the 1970s. And for Silicon Valley Bank, Greg Becker and his team to completely ignore all those signs. So on one hand, I think it's an isolated event of incidences that led to their demise. But at the same time, there is the potential of systemic event if other bank investment committees did the same thing.
Sure.
And that's going to come out pretty quickly.
Right.
However, banks, many of them take more of a conservative approach in managing their treasury and their assets and shorten their durations. So, and that's what we're doing. We have CDs that mature in 6 to 9 months, 3, 6, and 9 months. So I'm not worried if those CD values go up or down, or treasury bills or bonds go up or down, because I'm just holding a maturity and locking in high 4s and low 5% rates. So I'm not worried about our clients losing their principal. The principal is guaranteed. We'll hold the maturity. If we had 20-year treasuries, that's a whole nother problem.
Sure.
None of us want to wait 20 years, but 3, 6, and 9 months is okay. And we're building in our portfolios laddered maturities of our CDs so that they're maturing and being able to reissue if we want. And I think interest rates like the 70s and early 80s are going to keep going up probably for the next 8 to 10 years.
Awesome.
So we're on the other side of this scenario for our clients. We're investing in a rising interest rate market instead of losing money because of it.
Right.
So back to the question at hand, I think it's both. I think Silicon Valley Bank set themselves up with a number of events that led to their ultimate demise, which is when the treasury market plummeted. And I'm hopeful that it's not systemic, that other banks and investment committees have been able to hedge against rising interest rates. You couldn't ask for Jerome Powell and the Federal Open Market Committee to be more clear with their objectives.
Yeah.
They did nothing that was a surprise to anybody.
Mm-hmm.
And hopefully the major banks, many of them or all of them, hedged against that.
Right.
There still is the issue of these billions of dollars of 2 and 3 and 4% 30-year fixed mortgages that somewhere has to be deployed. Someone's going to sit on 2 and 3 and 4% returns for a long time.
Yeah.
And people are not going to sell their homes, in my opinion, and jump out and buy another home and get 6.75%. So I think the housing market is going to be, what's that, Matt?
Yes. Yeah, I don't think so. I think there's going to be a lot of holding and at a significant rate than in the last 20, 30 years.
Right. Yeah. And so I believe it's both, and it'll come out very quickly as these portfolios, what is called mark to market. So banks have to provide financial reports to regulators. They give a mark to market, which states what is the market value of their portfolio today.
Mm-hmm.
And it has to meet these ratios, and it's going to start coming apart pretty quickly. The fact that here it is March 15th, 2023, and the bond market plummeted last year. So the fact that we don't have a rampant number of bank foreclosures and collapses going on right now as we speak may be an indication it's not so bad. And the ones that were caught on the wrong side of this are showing up right now. And the fact that there's less may be positive and hopeful. So it remains to be seen. It's not going to be years, it's going to be months to see where banks are.
Yeah.
So and
we'll be watching closely.
Yes, absolutely. But for our investors, we'd been talking about this for years. We implemented the recommendations we said we would early last year, and now we're getting the benefits of high interest rates in CDs. Last week, or earlier this week, I was able to lock in 5.2%. What we bought for our clients in January is 4.7% 9-month CDs. So those are good rates.
Yeah.
And as you and I talked about a couple of podcasts ago, the 40-year average of the S&P 500 is 7%.
Yeah.
So if we can get 5% with no risk,
Guaranteed.
we're 2/3 of the way there, right?
Yeah.
Of an
That's
annual
awesome.
return. So anyway,
all right, excellent.
Yeah, so that's our analysis of Silicon Valley Bank and the banking industry. We always remain positive because positive is 2/3 of right. So we'd rather be on the majority opportunity of being on the right side of forecasting, and hopefully the banking industry will start settling down. News will start settling down. Of course, the media will take advantage of all of this as well.
Yeah, they love negativity.
Yes, exactly. But so anyways, thank you for listening to us. If you have any questions, feel free to reach out to Matt and I, give us a call or send us an email. We look forward to talking to you, and we'll see you next week. Bye.
Thanks.